One of the biggest frustrations new traders face when trying to sell put options is realizing you need thousands of dollars in capital just to make a single trade. It feels like the strategy is locked away for just big accounts only. But here's the thing, there's a simple hack that lets you sell puts without tying up a lot of capital, and it works perfectly for small accounts. In this video, I'm going to break down exactly how you can use this strategy to generate income with a fraction of the capital and, in fact, use this strategy to grow your small account fast. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world and are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. With that said, let's jump in and get started. So let's assume you really like Meta and want to sell puts on Meta to generate income. So the first thing I do before selling puts on any stock is to pull up its 3-month or 6-month chart. Now, the 3-month chart gives you an indication of everything that's been happening with the stock over the past 3 months. But if you like a larger time frame that I like, I go with the 6-month chart. So right here, I have the 6-month chart pulled up. And I also used a couple of other indicators to help me decide at what levels I should be selling put options. So right now, I have the Bollinger Bands set up on this chart. Now, for those not familiar with the Bollinger Bands are a set of bands where the stock generally tends to remain within the Bollinger Bands 95% of the time. So anytime the stock jumps out of the Bollinger Band, whether on the upside or on the downside, it generally reverts back and comes back inside. So if we see this one instance right here on July 31st, Meta jumped. This is right after earnings, I believe. Yeah, so on 7:30, right after earnings, Meta jumped all the way to 782. And obviously that expanded the Bollinger Bands because it went right outside the Bollinger Band. But then in the days to follow, it quickly reverted inside the Bollinger Band. And basically, if you look at where it's trading right now, it's at the bottom of its Bollinger Band. Now, if you like to sell put options for a living, which I do, right here is a perfect setup because anytime a stock is trading at the bottom of the Bollinger Band, you can expect a slight bounce. Now, obviously, nothing's guaranteed in the stock market, but generally speaking, anytime a stock comes all the way to the bottom of the Bollinger Band is a great area for a bounce. And knowing that Meta's at the bottom of the Bollinger Band, I still want to be safe and look at additional support levels slightly below the current level. So looking at additional support right here, the first obvious level of support I see is the bottom of these candles right here, because we had a lot of support all the way from July 16th through July 30th. That's a couple of weeks. And there's a lot of strong support. So this is around the 696 level, which is about $40 lower than the current price. So I definitely like this level right here. So let's go to the options chain and see what kind of premium we can collect. I'm going to go out 28 days to the September 26th option chain. We don't have a 696 strike price here in the options chain, but we either have a 695 strike price right here, or we have a 700 strike price. So it would make sense to choose from one of those. Looking at the deltas, the 700 strike price is a delta of 23, so slightly aggressive. And then the 690 strike price has a delta of 19. Now, looking at some additional stats, I also like to check out the volume and open interest at each one of these strike prices. And as you can see, looking at the 690, the 695, and the 700 strike price, the 690 strike price has the most open interest and volume. So keeping that in mind, I like to move forward with the 690 strike price. Anytime you want to sell a put option, you can go ahead and click on the bid price and then the order ticket will load up. Now, obviously the bid is at 620 and the ask is at 640. So we can get this order filled at the mid price, which is 630. Now, since one options contract lets you control 100 shares, you would take the $6.30 and times it by 100. So that means that if you sell one put of the 690 strike price, you would collect approximately $630 in premium. Since we're going with the 690 strike price, you would have to put up a collateral of $69,000, which is just taking the 690 and times it by 100. So again, people don't have $69,000 or $70,000 just lying around. Even people who have a decent size account, it's a lot to put up $70,000 just to sell one put option on a stock. So again, it's probably not the best utilization of your cash. So keeping all of those things into mind, what we could do is if I go ahead and expand this options chain, and we right now have the 690 put selected. If I go up here and if I go up 10 strike prices and click on the ask right here, now what this does is create a spread. So instead of requiring $69,000 to sell one put option, we've now built a spread. And since it's a $10 spread, which is the difference between the 690 strike price and the 680 strike price, all we're going to do is take the 10 and times it by 100. So to sell one spread on Meta now would only require a collateral of $1,000. For that, we're collecting $1.45 in premium. So if we go ahead and do the math, that's taking $145. And if we divide that by 1,000 and times 100, that's a 14.5% return in just about 30 days compared to just about a 1% return that we had selling one put option. Again, that would require a collateral of 69,000 versus only requiring $1,000 to put up this trade. You can put up this trade with even less capital than $1,000 if you'd like. So in that case, I could just do a $5 spread instead of a $10 spread. So we'll leave the 690 strike price the way it is, but instead of selecting the 680, I'm going to go with the 685 strike price. Now, since this is a $5 spread, you would only require $500 in collateral to open up this spread. Obviously, because it's a $5 spread, our premium went from $1.45 to just about 75 cents, about half of what we were collecting. But in this case, you're only putting up $500 and taking less risk compared to putting up $1,000 in collateral. If you remember, by selling one put option on Meta, we were collecting a little over $600. So if you want to target the same amount in premium, all you would have to do is basically change the number of contracts. So instead of one spread, you can go ahead and sell 5 spreads. And then in that case, you would collect $375. Or instead of the $5 spread, if you go back to the $10 spread and you sell 5 put credit spreads, in that case, you would collect $710 and you would have to put up $5,000 in collateral. Versus if we just sold one put option on Meta at the 690 strike price, that would have required us to put $69,000 in collateral. And for that, we were collecting a little over $600. And in this case, we're putting up about $5,000 in collateral and collecting $710. So if we do the math, that's $710 divided by 5,000 in collateral that we're putting up for this trade. That's a return of 14% in just about 28 days. And not only is that a fantastic return, but you achieved that return only putting up a fraction of the capital that would be required in case you were to just sell one put option on Meta. So now that we've discussed the collateral required and the premiums that we would collect in each scenario, let's also compare both strategies and see what would need to happen at expiration for you to keep 100% of the premium that you collected at the time that you opened the trade. So in case you were simply selling a put option of the 690 strike price, all you would need to do is for Meta to stay above the 690 strike price by expiration, and then you get to pocket 100% of the premium. If Meta were to drop below $690 by expiration, then you would be assigned 100 shares of Meta at the 690 strike price, and the $69,000 collateral that you put up to open this trade would be utilized to buy those shares. Comparing that to the put credit spread, let's assume we went with the $10 wide spread, which is selling one put at the 690 strike price and buying another put at the 680 strike price. Now, again, since it's a $10 spread, that would require $1,000 in collateral. And all you would need to pocket 100% of the premium that you collected at the time that you opened up the spread is for Meta to stay above $690. Now, we have the P&L chart right here of the 690, 680 put credit spread. And as you can see, as long as Meta continues to stay above the 690 strike price in this green zone, you get to pocket 100% of the premium. Once Meta starts drifting in this red zone right here, your trade would start losing money. As far as risk management on the spreads, you might look to exit your position anytime the trade is in profit greater than 50% or higher. So let's assume that you open up the spread today and in just a couple of days, your trade is up 70%. So at that time, it's best that you go ahead and take profits and close out the trade so your trade is not exposed and open until expiration in case the market changes. On the flip side, if you see at any time your trade is negative 2x or 3x the amount of premium that you originally collected at the time that you opened the trade, it's time to go ahead and cut your losses and move on to the next trade. So that way there are no chances of a higher loss in case the stock continues to trend downwards. So that's it for today's video. If you enjoyed it or learned anything useful, don't forget to hit that like button, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.